We are very pleased to have with us today Andreea Rotarescu from the Wake Forest University in North Carolina. She's visiting DC right now. She's assistant pro, and she's going to talk about productivity slowdown and firm exit, the ins and outs of banking crisis. So we agree with Andreea that she's happy to take questions, clarifying questions along the way, and like big, discussion questions. We can maybe have towards the end. But feel free to please interrupt and if there are clarifying questions along. So Andreea, the floor is yours. So very happy to have you.
Thank you so much, Carolina. Thanks for the introduction, and I'm really happy to present today. Thanks so much for including me on the program. So yeah, like Carolina said, I'm excited to talk about my paper on productivity slowdowns and firm exit, and I'll be looking at this question in the context of banking crises. So let me jump right in. With a bit of motivation behind the paper. So by now it's a fairly well-established stylized fact that countries that have suffered from banking crises also experience pretty sharp downturns thereafter, and these downturns are also followed by particularly sluggish recoveries. So to make this point visually, this graph is plotting average productivity for different groups of OECD countries over time. And what we see and what immediately stands out is that for one particular group of countries, which is commonly referred to as the Euro periphery, this group of countries has performed much worse in terms of productivity after the financial crisis. So the drop was very sharp, and then the recovery was much slower than in the average OECD country. And so this group of the Euro periphery, it's composed of Greece, Ireland, Italy, Spain, and Portugal. And these are all countries that at the time experienced very severe banking crises. And so this kind of begs the question of whether and to what extent banking crises are to blame for such, big drops in productivity and slow rebounds thereafter. So this is kind of where my paper comes in. So let me give you an overview of what this paper is going to be about. So the question that I'm answering in this paper is fairly straightforward. It's basically, what is the effect of banking crises on productivity and output? Now, of course, this is a fairly well-studied question, but I argue that my my paper is novel in at least two key ways relative to the existing literature. So one big innovation, the way I see it, is that I look at much longer term effects of the bank shock. So I look at a period of like up to 10 years after the banking crisis hits. Whereas most of the papers in this literature focus on much shorter term effects. So they look maybe 2, 3, 4 years out after the financial shock has hit. And then, so that's one key innovation. And then the second key innovation of my paper is that I decompose the effect of the bank shock along two margins. So one, the first margin is what I'm going to be referring to as the extensive margin. So what I mean by that is that, firms are forced to exit prematurely in response to the bank shock. And then the other margin that I'm going to be looking at is what I'll refer to as the intensive margin, and that one comes more from firms being forced to cut down or slash productivity enhancing expenditures due to the bank shock. So I'm going to apply this analysis to Spain. And to give you, first glimpse into the Spanish data, this graph is showing the evolution of average exit rates in red, and average productivity growth in blue. So what we see, excuse me, what kind of immediately stands out is that, around 2007-8, at the onset of the crisis, exits surge, and at the same time, productivity growth takes a big dip. Right? So this already kind of hints to this idea that if we're interested in productivity dynamics, it's important to also take into account what's happening with exits. Okay. So now let
ask you
me
something very quick on
yes.
or maybe you will talk later on the exits. No, like that this is like, so this is from Orbis, like this the exit
Yes.
rate is computed. Can you have you done anything like to try to see like whether this fits the official like census type of statistics? Like Orbis is a bit problematic in terms of exit rates and.
So I try to be careful about that. So I observe the status of activity of firms. I'm going to talk about that when I get to the data. But basically, I mark the firm as an exit if it's reported to be in bankruptcy or liquidation. So it's not just that it disappears from the data. But you're right, I should superimpose on this just aggregate exit rates from Eurostat. Right off the top of my head, I don't remember what those look like. But yeah.
The other like unusual thing of these exit rates in this graph is that for Europe, like there was like the sovereign debt crisis, and that is around like 2012.
Right.
So it looks a bit the exit. So it looks like there is like a big exit around the US crisis, right? And then kind of like it goes back. So I would have expected, I guess, like another spike, maybe like around the 2012, but it seems to slow down around that time. I don't know.
Right. I mean, there is another kind of a second peak here in 2012. But you're right. It's not as big a jump. So I can definitely compare this. There's superimpose on this the aggregate exit rates to see how they compare it. Like right now I don't remember what those look like, but comment well taken. Okay, so now to give you a little more direct evidence of the link between bank performance or bank distress and firm outcomes. I'm going to run some panel regressions at the firm level, where the outcome of interest is going to be in turn exit and productivity growth. And then on the right hand side, I have so the main explanatory variable is one that captures, bank distress at the firm level, and I'll explain how I get to that measure. And I interact that with a post 2007 dummy. And then in addition to that, I add a host of, time varying firm controls, and then I saturate the model with a rich set of fixed effects. So I have firm level fixed effects to absorb any unobserved, firm characteristics that might be confounding the results. And then also a detailed sector by region by year fixed effect as well. And then a brief note on the standard errors. I'm using two-way clustering at the firm and year level, right? So that means that I'm allowing for shocks to be serially correlated within a firm, but then also correlated for the same firm across years. Right. So now let me go back to the main explanatory variable and explain this in more detail. So excuse me. So I obtain, so the bank measure is derived from the amount of government aid that the bank received during the restructuring of the banking system. And I normalize that by the assets or the size of the bank. Right? And then for each firm, I take the average of this ratio across the banks that lend to this firm. Right? So this gives me sort of a firm level measure of the weakness of the banks that it's tied to, right? So the way this is measured is a higher bank measure means a higher, so the banks that the firm is borrowing from are more distressed, right? So when the bank measure goes up, that means that signals weaker banks. Okay, so let's look at the results from this simple exercise. So what we see is that firms that are exposed to weaker banks are more likely to exit after the crisis hits, and at the same time they suffer bigger drops in their TFP growth. Okay? So just to put these estimates in perspective and give you a sense of the magnitude. Going from the healthiest to the least healthy or the weakest bank increases the firm's probability to exit by about 1.8 percentage points, and it decreases their TFP growth by around 2 percentage points. Right? Now, the fact that, so the effects that we see in column 2 here on TFP growth, of course, those are measured only using surviving firms. Right? Because those are the firms for which we observe the change in productivity growth year on year. Okay? Now, what we see in column 1 is that firms tied to weaker banks are more likely to exit, right? So this is telling us that exit is systematically linked to bank performance, right? And so this is potentially problematic, right? Because to the extent that it is the worst or the hardest hit firms that are forced to exit after the banking crisis, we might actually be underestimating the effect on productivity growth if we only look at surviving firms, right? So in other words, the fact that exits are systematically linked to bank performance introduces the possibility of a sample selection bias, right? So the rest of the paper is going to be about teasing out and controlling for this exit bias. Okay, so let me go over, very briefly over some related papers in the literature, and I'll talk a bit about how my paper relates to these. So, there's a big literature on the so-called real effects of the bank lending channel. Now, earlier papers in this literature don't look at firm level outcomes, right? So they look at maybe sectoral levels of activity or regional levels of activity. Now, more recent papers in this strand do exploit firm level information, but they focus mostly on employment as the main outcome, not so much on productivity or capital. And then of those papers that do look at productivity, a lot of them don't take specifically into account this exit margin that I argue is important. Okay. And then more broadly, this paper fits into the literature on finance and productivity, to which Carolina has actively contributed, and I'm sure is very aware of. Okay, so with that, let me just kind of give a brief roadmap of what's coming next. So I'll spend some time first talking about the data and the institutional background in Spain at the time. Then I'll dive into the empirical strategy that I used to identify the exit bias, and finally I'll talk about the results. Okay, So on the data, right? So on the firm side, I have balance sheet data from Orbis. Like I alluded to before, I also have the status of activity of firms and when it changes. So that's what I use to pinpoint exits, right? So the status could be marked as active or inactive, and then if inactive, it can be in liquidation, in bankruptcy, or unknown. And so I guess another possibility is if the firm is part of a merger or demerger as well. So I consider exits to be only those that are explicitly marked as bankruptcy,
You
liquidation.
confirmed it. Yeah, I think so. Okay. He says you. Okay, I will look at it.
Right. So like I said, a firm is marked as an exit if it's dissolved in bankruptcy, in liquidation. So very clear, indications of it dying out. So in a sense, you should think of my my exit measures as kind of underestimating the true amount of exits. Or a lower bound, I guess. And maybe part of that also explains why maybe the peaks or the jumps are not as maybe you would expect.
Is this from Orbis historical? Like,
yeah. So
and then the flag is it varies over time, or is
so the flag, no, so it's it basically for each firm it says the year when that status has taken or has occurred. So yeah.
Something that might be useful, like seeing a bit the motivation of the paper, is if you could decompose total aggregate productivity in the intensive extensive. So how much changes in TFP growth, how much it comes from entrants, exiters, and continuing firms.
Right.
And since you're going to be focused on those that exit, compare what is the average productivity differences, like between those that continue versus those that exit and those that enter, because entry is another margin that might be.
Sure. Yeah, that's a great comment. Yeah, that's something I can easily sort of decompose and show. Yeah, that's a great idea. Thank you. All right, so on the firm side, then I also crucially have bank relationships. So for each firm, I see the names of up to 10 banks with which a firm has a relationship, and that's what I use, to compute sort of bank measures at the firm level. Right now, one drawback of this is that this measure of bank relationships is static, so this doesn't vary over time. But this shortcoming is mitigated by a big literature, not just in Europe, but even in the US, showing that bank relationships tend to be very sticky over the cycle. So it's costly to change lenders, and so these things have big inertia. Okay. So that's the firm side. Now on the bank side, I collect aid amounts, right? So how much the bank has received in government aid, be it as a liquidity injection, recapitalization, and so on. I've normalized that by the bank size. And finally, I also collect information on the regional market shares of banks. And I'm going to exploit that later on when I talk about how I deal with the exit bias. I'm going to explain that in more detail later. Okay, so before going into more details, I just want to pause a little to hope to convince you that Spain is a great setting to analyze the type of question that I'm interested in. So why is bank useful when we look at effects of banking crises? Well, first and foremost, firms in Spain are very heavily reliant on banks, right? So most firms are small and medium-sized enterprises. They're private, unlisted. They have, most of them have no other source of external finance other than banks, right? And the banking shock, the banking crisis was extremely severe, and so it, when all was said and done, bailouts and the government intervention amounted to up to like 5% of pre-crisis GDP. And finally, one special and unique aspect of the Spanish banking system that I'm going to heavily exploit is the presence of a special type of savings banks. So before the crisis hit, Spain's banking system was basically split between savings banks and commercial banks, and these groups accounted for roughly the same amount of the total credit, right? So these savings banks were a major type of financial institution, and these were at the epicenter of the crisis. So and at the same time, they're also kind of at the core of my identification strategy. So let me just spend a few more minutes talking about these savings banks, or cajas as they're called. So like I had alluded to before, the cajas collectively accounted for about half the total amount of credit. So they were major players, and they were kind of in a nutshell badly run. Right? So why were these institutions badly run? Well, a host of reasons. I'm just going to name a few. First, they weren't listed on the stock market, so that meant they couldn't raise capital when they got in trouble, but also they weren't really subject to market discipline of any sorts. Then the way they were chartered, they had a very unclear recapitalization procedures. So even after the government decided to do something about these institutions, it took a long time for the aid to be rolled out and for everything to be hashed out. So it was a very drawn out process. And yet another peculiar aspect of these is that some of them were partially controlled by regional governments. So that included, yet another layer of inefficiency. So when all said and done, nearly all of these cajas failed by the end, and ended up being reorganized as commercial banks. Right? So in fact, this was a condition of Spain receiving aid from the from the European Financial Stability Facility. Like one condition for that was that these cajas had to be reorganized and redefined as commercial banks. And another key aspect of these cajas that I'm also going to heavily exploit is that for most of the time that they were in existence, these cajas were limited to operating in their home regions. Right? So that meant that they had a very strong territorial basis, and they maintained that kind of strong regional footprint, even after they were allowed to expand out of their home regions. So this is crucial, and I'm gonna rely on this later on. Okay, so just to give you kind of a quick idea of how these savings banks compared to commercial banks, or how their lending patterns differed. So we see that after the crisis, these savings banks contracted lending much more than commercial banks. Right, commercial banks contracted lending too, but the difference is quite stark. And so one quick note is that in my sample, all the weak banks are savings banks. So I'm, throughout the talk, I'm going to be referring to savings banks, weak banks, interchangeably, because for the purpose of my sample, they're exactly the same. Okay. And so one last thing before I kind of dive into the core of my empirical strategy is I want to try to convince you that firms that were borrowing from weak and healthy banks were not all that different going in. So there were no huge pre-trends, before the crisis. So the graph on the left is showing exit rates for firms tied to weak and healthy banks. So we see that kind of the two lines kind of track one another and then start to diverge, post 2007-8. And then the same is true for productivity. So if you look at the graph on the right, the two lines going to follow one another pretty closely, and then start to really move apart after the crisis. So in the paper, I have a more detailed table where I show that a host of other firm observables are also very similar pre-crisis for firms borrowing from healthy versus weak banks. But for the purpose of this, I just wanted to show you this visual representation. Right. So hopefully this has helped to convince you that there were no